Welcome to MBAV 6601, which is the course called International Business. This is the PowerPoint lecture video for Chapter 10. We will cover material in the book from Chapter 10, and we will look at some news headlines that relate to our material. I am Dr. Bruton, and it's my pleasure to be with you today. My email address is on the screen if you have any questions for me. This is the last chapter of Unit 6. If you are now studying Unit 5 or Unit 6, I would suggest that you finish the Unit 2 essay and the Unit 4 assignment if you have not already done so. The Unit 6 assignment is due at the end of Chapter 10. In the last presentation, we discussed the function of foreign exchange and how companies use it to conduct international business. This presentation focuses on how the exchange rate is established. In other words, how do we determine what a dollar is worth as measured by your currency or any other currency? The conversion rate is pretty important because people, companies, and even countries want to get the best value for their money. The length of this presentation will be about 27 minutes from start to finish. The picture on this slide is Ha Long Bay in North Vietnam. It's one of the prettiest places in the world. If you have not been there, it is certainly worth the trip. Let's talk about Bretton Woods. In July 1944, delegates from 44 Allied countries fighting Germany and Japan in World War II met in a ski resort in New Hampshire called Bretton Woods. If you look at the picture on the slide, you'll see what the meeting looked like. In that meeting, they established the financial system that you recognize today. They established the International Monetary Fund, the IMF. They established the organization that became the World Bank. And they established a system of currency convertibility. The value of the dollar was fixed at $35 per ounce of gold, and each country's currency was based off that standard. Some things you need to know about Bretton Woods. First, the IMF quota system is the money a country pays when they join the IMF. The amount of money is broadly based on its relative size in the global economy. The IMF lends this money to countries who are having financial difficulties. Currently, the IMF has about $1 trillion to lend out. Special drawing rights are a monetary unit created by the IMF in 1969. The SDR serves as the IMF's unit of account and can be used for IMF transactions and operations. In 1981, the IMF pegged the special drawing right to the basket of four currencies: the US dollar, the euro, the British pound, and the Japanese yen. In 2016, the Chinese yuan was added to the basket. Every now and then you'll hear central bankers talking about getting rid of the dollar and replacing it with the SDR. The dollar is under US control, while the SDR would be under IMF control. Under the Bretton Woods Agreement, any country that earned US dollars through currency conversion could exchange them for actual gold at the rate of $35 per ounce. In the 1960s, the U.S. was financing NATO, the North Atlantic Treaty Organization, and the European countries were accumulating a lot of dollars. They would take those dollars and buy gold from the U.S. at $35 an ounce. In 1971, the U.S. balance of trade deficit continued to worsen, and the United States closed the gold window. Consequently, the dollar was devalued in 1971 and again in 1973. That was when major currencies began to float against each other, relying on the foreign exchange market to determine their value. By 1981, Bretton Woods system was dead, but there's still the IMF and the World Bank to show for it. Currency over time fluctuates up and down in comparison to other countries. That means the currency can be worth more sometimes and worth less. To maintain stabilization, a country's currency cannot be allowed to fluctuate too much. The IMF recognizes and tracks three categories of exchange rates. A country's currency can be directly pegged by another country's currency. This is referred to as a hard peg. A hard peg is used by countries that really don't have a strong economy. And this happens two ways. The first way is called dollarization. It occurs when one country adopts another country's currency as their own. For example, countries like Zimbabwe or Ecuador have adopted the US dollar as their own currency. A second example of the hard peg is a country that prints its own currency, but it has the same value as a foreign currency. For example, a country might have a currency board that collects all of the US dollars that come into the country, and then they print a local dollar for each US dollar collected. The second category is called a soft peg. This is where the currency can be adjusted up or down based on physical strength. A soft peg is the most common type of currency, and it's used by developing countries with a well-developed economy. On a periodic basis, perhaps monthly or quarterly, the treasurer of the country will reset the currency's conversion rate against all major currencies. This has the ability to factor in inflation or deflation and trade deficits and surpluses. It makes the currency worth more against other currencies or sometimes worth less. There are several different types of soft pegs, but most countries peg their currency to another major currency or a basket of currencies and allows the exchange rate to vary plus or minus 1% from that value. Most countries use the US dollar or the euro to anchor their pegs. Seems like I read somewhere where the Vietnam dong uses a soft peg plus or minus 3% of the US dollar. A third alternative is a floating currency that depends on supply and demand of outstanding currency. If demand for a currency goes up, the strength of that currency goes up as does the value. Most well-developed countries let their currencies float against the currency of other well-developed nations. Exchange rates are the direct responsibility of a country's central bank. So how does that work? In most countries, the central bank is responsible for the policies affecting the value of its currency. However, there are about 5 to 10 countries with an independent currency board outside of the central bank that control the amount of currency issued. In the United States, the New York Federal Reserve Bank, known as the Fed, is responsible for intervening in foreign exchange markets to achieve dollar exchange rate policy objectives. The U.S. Treasury sets the policy and the Fed executes the policy. Central bank reserve assets are kept in three major forms: foreign exchange reserves, IMF-related assets, and gold. When a central bank executes policy, it's called intervening in the market. A central bank can intervene in currency markets in several ways. The U.S. Fed, for example, can use foreign currencies to buy dollars when the dollar is weak, or sell dollars for foreign currency when the dollar is strong. Central banks may coordinate actions with other central banks. They may make policy statements to influence the markets, and they intervene to reverse, resist, or support a market trend. It's very difficult, if not impossible, for intervention to have a lasting effect on the value of a currency. Given the daily volume of foreign exchange transactions, no one government can move the market unless its movements can change market psychology. Intervention may temporarily halt a slide, but the country cannot force the market to move in a direction it doesn't want to go, at least for the long run. Fully convertible currencies are those that the government allows both residents and non-residents to purchase in unlimited amounts. Some countries limit or control access to their currency. Frequently, I hear the term hard currency and soft currency. A hard currency, such as the US dollar, the euro, the British pound sterling, and the Japanese yen, are those that are fully convertible. Highly liquid and relatively stable in value over a short period of time, they are generally accepted worldwide as payment for goods and services. They are also desirable assets. Currencies that are not fully convertible are called soft currencies, and they have just the opposite characteristics. They are very unstable in value, not very liquid, not widely accepted as payment for goods and services. This next slide shows the mechanics of how exchange rates are determined. First, currencies that float respond to supply and demand conditions. Currencies that are pegged are at the mercy of the floating currency. So let's look at how supply and demand affect floating currencies. To start with, let's say that demand for a currency stays constant. If demand stays constant, then if supply goes up or down, prices will go in the opposite direction. If the supply of currency increases, then its value goes down or the currency gets weaker. On the other hand, if the supply of the currency decreases, then the value goes up and the currency gets stronger. For example, let's say a country like Vietnam wants their currency to get weaker so that exports will get cheaper and they can sell more product. In reality, the dong has a soft peg to the dollar. The state bank, if they wanted to, could break that peg. Vietnam's central bank would sell some dong in the foreign exchange market and buy either US dollars or euros. Since there is more dong in the market, the value of the dong goes down. If the state bank wanted to raise the price of the dong and make it stronger, the state bank would sell their supply of US dollars or euros and buy up the dong. Bear in mind that all we are doing at this point is changing the amount of currency in the FX market. Here are three headlines. Two of the headlines show the currency getting weaker, and one headline shows the currency getting stronger. First headline is the one on the top. New Zealand dollar rates gain despite COVID-19 fears as currency rivals plummet. If you read the small print in the article, you'll see that three things happen to make the Kiwi, that's the name of the New Zealand dollar, stronger. First, New Zealand's trade balance report came back strong for January. Second, the U.S. dollar slumped on the anticipation that the U.S. Fed would cut interest rates. Third, the Chinese currency has plummeted because of the virus. So the balance of trade is good. The U.S. dollar and the Chinese yuan have weakened. But all three of those make the Kiwi stronger. Look at the next headline. Zimbabwe hikes interest rate to 70% to help plummeting currency. Zimbabwe is experiencing 200% inflation. Inflation is like printing money. It makes the currency very weak. Raising the interest rate is the prescription to strengthen the currency. A high interest rate reduces the money in circulation. And the third headline, the one on the bottom, Syrian Kurds seek relief from plummeting pound. Syria is in a war zone with Russia and Turkey going at each other. There is a shortage of goods and it takes more money to buy stuff. This is a form of inflation also. Thus, the currency is weak. From these three headlines, you can see that different factors can cause a currency to rise or fall. Some of these are very predictable. There are other factors that affect the supply and demand of the currency. Some factors have a greater impact than others. Inflation and interest rates have an immediate impact on currency strength. Let's talk inflation. For example, in the U.S., desired inflation is 2% per annum per year. If 4 or 5% inflation happens, investors will sell off the currency, which will push demand down, and consequently, the price of the dollar declines. Let's talk interest rates. The higher the inflation is, the higher the interest rate needed to bring it back down. Remember that headline on the previous slide about Zimbabwe? They had 200% inflation and raised the interest rate to 70%. Higher interest rates lower inflation. Lower inflation makes the currency stronger and increases the value of the currency. The current account balance and public debt will have a short-term impact on a currency's strength. Let's talk current account balance. The current account is an important indicator of an economy's health. It is defined as the sum of the balance of trade exports minus imports plus any net profits from abroad minus any net transfers to foreign sources. A positive current account balance indicates the nation is a net lender to the rest of the world. And a negative current account balance indicates that the nation is a net borrower from the rest of the world. It's better to be a lender than a borrower. Let's talk public debt. If a country is perceived to have high national debt without a credible plan for dealing with it, that can have a negative impact on the value of the currency. While the U.S. national debt exceeds $23 trillion, it is only 104% of the country's GDP. That may seem high, but many other countries, such as China, have much higher percentages of debt. I read on one website where it said that China's debt is 300% of GDP. The last two things to look at are economic performance and political stability. Both of those affect the long-term robustness of the currency. Looking at economic performance, GDP growth or stock market performance are proxy variables for economic growth. If GDP growth is strong and robust, the currency is considered strong and robust. Economic performance is the second best long-term indicator of currency strength. Political stability is the number one indicator of long-term currency strength. Political events are one of the biggest factors that affects currency exchange rates, and they can have a major impact on the particular value of a currency in a matter of minutes, depending on what type of event occurs. Elections can impact currency exchange rates. A candidate that is perceived as potentially increasing business taxes and regulations may result in a currency decline or a stock market decline. A military coup would certainly cause currencies to decline, at least until the new leader's stance on business policies is known. This slide gives you an example, a hypothetical example, of what might happen if there is inflation in your economy. The Vietnamese dong US dollar conversion rate is 23,269. And when the currency is periodically reset after the inflation is taken into account, it might change to 23,734. The Vietnamese currency is worth less against the US dollar. Thus, if you import anything from America, it will cost you more. That is how inflation impacts the value of the currency conversion. Now that you know what variables affect the currency, you can predict or forecast the long-term trend of exchange rates. Fundamental analysis and technical analysis are the most commonly used methods. Experienced traders who are well acquainted with each method can use a mixture of the two with great efficiency. The first method of FX forecasting is fundamental analysis. Considerable factors and statistics such as unemployment, inflation, interest rates, public debt, government spending, trade deficits, stock market growth, treasury bond sales are all applied to econometric models to predict how certain events will affect currency supply and demand. The second method, used for forecasters, is technical analysis. There are three basic principles for making projections. These principles are based on, number one, the impact of current events, number two, trends in price movements, and number three, past foreign exchange history. Being able to forecast or predict the direction of the exchange rate can be advantageous. If you know with some degree of accuracy if a currency is getting stronger or weaker, you can take advantage of the trend. This is called hedging strategy. Basically, you are taking an action to offset the impact of a currency moving in one direction or the other. For example, if a currency weakens, that means it's cheaper for tourists to come visit you. If you own a hotel in a country with a weak currency, go advertise your hotel in a country with a strong currency and tell everyone how cheap it is to come visit. They will bring their strong currency to pay for their visit. Another hedging strategy is to open factories where you expect the currency to be weak. The strategy is to produce products in countries with a weak currency and sell that product in countries with a strong currency. Basically, that's what Taiwan, Korea, and Vietnam are all doing. Their currency is not as strong as the US dollar or the euro, so that's who they sell to. Another hedging strategy is to borrow money from countries with a weak currency. Put that weak currency to work in a strong currency nation. A strong currency is less likely to have inflation. Because of the inflation, a weak currency is more likely to get weaker than get stronger. Thus, it will cost you even less to pay back what you borrowed. Usually there are specialists trained to do these kinds of things. Managers who do not understand how currency values are determined can make serious and costly mistakes. This chapter was a good review of the variables that make a currency stronger or weaker and things a business can do to take advantage of the trend. Next time, we start with Chapter 18. Have a good day.